Hi, I'm Rocco Johnson, your lifestyle focused wealth coach. Thank you for joining us. Today, I'm going to share with you the top 10 reasons why whole life insurance in your retirement plan might make sense. Are you ready? Hey, good afternoon, good day, everybody. I'm Rocco Johnson, your lifestyle focused wealth advisor. Thank you for joining us. It's Lifestyle Focus Friday, and I am so happy to be here to see you guys. Tune in. We got some great stuff for you today. Today, we're going to be talking about our top 10 reasons why life insurance makes sense in your retirement. And I'm excited to talk about the topic because I've been getting a lot of other information. I've been getting people who are asking questions about real estate and buying things. And how is it that this tool, this financial tool that we know very little about, can be so important in retirement or helping us get to where we want to go in retirement? Well, we're going to talk about my top 10 reasons today and share that information with you so that you can get connected and be part of it and see what's really going on. All right. So sit back, relax, and unwind. I know on camera right now you're looking at my screenshot, but I will be right back. Hey, join our Lifestyle Focused Wealth community. Membership starting at $16 a month when you pay the annual subscription. So register online today at www.lifestylefocusedwealth.com. Hey, what's happening, everybody? I'm Rocco Johnson, your lifestyle focused advisor here. Thank you for joining us. It's crazy. It's Lifestyle Focus Friday, and this is when the lights go out. Are you ready? Today, we're going to be talking about our favorite 10, our top 10 reasons why life insurance makes good sense in your retirement plan. Makes good sense in your retirement plan. We're going to talk about our top 10 reasons today. And before we get started, we're going to give you just a rundown of what you need to do when you become part of our network. So thank you for joining us. All the love and all the letters and emails that we've been receiving. It's been overwhelming, and I just want to say thank you from the very beginning of our podcast today. I just want to say thank you very much, and hopefully you continue to stick around and learn more and more and more. So welcome back to our channel. Today, we're going to talk about the world of whole life insurance and the protection it gives you and the top 10 reasons why it makes good sense to have this financial tool that no one talks about in your financial portfolio, in the entire portfolio. So I want to encourage you beforehand to do me a favor. If you like something that we're talking about, down here in the comments, I want you to click the words takeaways and type in the takeaways. If I say something that it really sparks something in your brain and you think you can use it, put in there takeaways from this broadcast. It helps us to understand and figure out, hey, what it is that you want to hear. What is it that you want to learn that you're not hearing from anyone else? And we want to be that person or that resource for you that actually gives you what you need to make high-end quality decisions about your finances and other things about you building wealth, if that makes sense, right? We want you to be a part of our network. And if you're not part of our network, it's our Lifestyle Focused Wealth Network. And our network, you can do it very easily. Like I said, join online. It's $16 a month. It's very simple to be a part of it. And all you got to do is go to lifestylefocusedwealth.com and you will see it right there. Okay. And we want to see you in the house. We want to talk to you in the house. And we're going to talk to you about our top 10 reasons of why life insurance makes good sense. Why does it make good sense? So let's just jump on into it. Let's just jump right on into it. Our number one reason today is freedom. Freedom to spend your retirement assets how you want to. Man, that is important. That's important from the jump. If you're worried about robbing the heirs of, the inheritance or upon your passing, some of our senior citizens spend very little in retirement. So the death benefit provides life insurance benefit to the beneficiaries, typically in a tax-free income. So it's typically tax-free. So this helps you give retirees the ability to spend your assets. It's giving you permission to go out and live the lifestyle that you deserve, an abundant lifestyle at that. So potentially leaving a legacy for loved ones and the necessary funds to pay the taxes and final expenses, it keeps us from living the life that we really deserve, that you really work for. And my number one reason out of our top 10 today is that life insurance gives you the freedom to spend your assets in your retirement years. So if you're planning ahead and you're a young person listening to us today, keep that in mind. Keep that in mind as you're planning your next steps and where to go. Number 2, increase your Social Security benefits for yourself and others. Okay? This is my number 2 reason. My number 2 reason today is it's pretty simple. It's pretty simple. Once we start understanding the value of this secret financial tool that most people aren't using properly, it gets to be pretty fun, you guys. Isn't it fun when you figure out the puzzle, or when you get to the last piece of the jigsaw puzzle and you got 1,000 pieces and you complete the last one? Isn't it amazing that that picture becomes very clear? And that's what we're doing with you. We're trying to make a picture that has many, many pieces to it very clear to you. Number 2 reason is Social Security benefits. It works for you simply because the accumulated, I'm going to try to say this in a way that everybody can understand. The accumulated cash value within the whole life policy, what it does, it gives you access to your capital as a supplemental retirement plan or a supplemental retirement income while delaying filing for your Social Security benefits. So if you're right there on the cusp of having to figure out if you're right there where you qualify for Social Security, maybe you have enough cash value that you can start to use as a supplement to your retirement income until you reach the full Social Security age. And that kind of helps you out. And if you can do that, both the worker and the worker survivors can maximize the amount of Social Security benefits available to you at that time. So taking Social Security earlier, it could affect you. It could affect your survivors. The benefits are for life. So you want to be very careful about how you decide and when you decide to take your Social Security benefits. Because, ladies and gentlemen, let me make sure you understand this. There are no do-overs. There are no do-overs. Once you make that decision, it's done. It's done for life. So make sure you give me a thumbs up in the comments down low so that I can understand that you are there and you're listening to me, that there are no do-overs when it comes to picking your Social Security, okay? So number 3, we're going to talk about tax diversification, okay? Tax diversification. It's important that we understand I'm not an attorney. I'm not a CPA. Get with your tax professionals if you want to make sure that what I'm telling you is the proper detail. But at the same time, tax diversification in this scenario, okay, the tax deferral of life insurance cash value, it allows taxpayers to diversify among other assets that they own that are currently taxable, and it reduces their current taxable income. If you don't need the income, you don't need to pay the taxes to it. You may not want to pay the taxes to it. So using your money from your life insurance allows you to be able to take policy loans from your cash value without taxes. So if it's unnecessary for you to have to pay taxes at an earlier situation, and you can bridge the gap between when you need it and when you don't, life insurance might make a good sense to you. This potentially reduces your taxation of Social Security benefits and the exposure that you have to Medicare benefits or surtax. So for those folks that are aging and getting into that realm, I'm going to encourage you to sit down with your financial professional. All right, just give us a call at Lifestyle Focus Wealth, and we can show you how that works and have that conversation so that your investment income for higher income payers isn't taxed unnecessarily, okay? For you folks out there that hit that bracket, it only makes sense, excuse me, to prepare. Number 4. Sorry, everybody. I got something in my throat. Oh, my gosh. Live on air. It is what it is. Grab some of our water and hang out here with you guys, right? Sometimes it just happens. It happens. We are live. I can't do anything about it. I am so sorry. However, number 4, we're going to talk about asset allocation. Asset allocation. My number 4 reason for our life insurance being ideal in your retirement plan is simply this. Whole life insurance is not subject to market risk. I'm telling you, it is not subject to market risk, which can allow for the riskier equity-based investments that you use can continue to be a part of the retiree's portfolio as a hedge against inflation. So you can use your funds to leverage from cash value in other places. And we've talked about that. You know, how you can take money out of one place and have it work in another place. That's leverage. Now you're not worried about or depending on the insurance policy to outperform inflation, which is not designed to do. But you have other things such as real estate, stocks, bonds, mutual funds, all those different opportunities out there that you're able to participate with while you're still compounding interest using your insurance product at the same time. So you don't have such a heavy concentration or exposure to your retirement funds. So it's unnecessary to take market risk when you don't have to, right? I think so. Because what we say in retirement, we don't get another opportunity. Put that down in the comments. Give me a thumbs up if you're still hanging with me, if I didn't just completely blow your mind with my choking on screen. Why didn't you guys come help me? You saw me choking. Why didn't you come help me? Right? That is okay. That is okay. That is okay. We're going to survive it. We're going to survive it. Number 5. Number 5 is our cash reserves for emergencies. Who says that, when we start talking about having emergency funds, if you're still putting money in your savings account or your checking account for a rainy day fund, maybe it's time to have another conversation. You can use your cash reserves for emergencies. There was a recent survey for pre-retirees and retirees that revealed that some were not prepared to address unexpected healthcare costs in retirement. And for those of you that have homes that you've lived in for 20, 30 years or own real estate, you might not be expecting those home repairs and the cost of supplies today. Outrageous. So, you want to be able to have the cash on hand if you need it to be able to fund your lifestyle or necessary costs that come up. Cash value can accumulate within your policy. And generally, you can access it through your policy loans tax-free. If you were to take out withdrawals out of your policy, now that's a little bit different to cover such emergencies. The money's there, but it could be a taxable event. But most people take it out in the form of a policy loan. That way they have the ability to give it back. We talk about becoming our own banking system here. And one of the beauties about insurance is it's just like a bank. And the idea for you is to start thinking like a bank, meaning that you take in deposits and then you loan money out, even if it's to yourself. But when you take those loans, you're not paying taxes. Instead, you don't have to pay taxes on the loan. Whereas other people who are using income or they're surrendering money from other places that generate an income, they're having to pay taxes on that money right then. So there is some of the balances that you may want to have more conversation about, learn more about, that you can take advantage of using your secret financial tool. There's no bank loan. There's no line of credit issues. Life insurance policies remain in force until it's surrendered or until you don't make a payment and lapse the policy. So once it reaches its stated maturity date, a couple things happen. The policy is either paid off, paid up, so you are earning more money than what the policy's than what you put into the policy at that point in time. Or, which comes first, as long as you continue making payments, your premiums are always going down because your cash value and your dividends are going up. So these are some of the things that I like about the insurance play that most people overlook in their conversation. And we're getting into the weeds a little bit, but I think it's important for you guys to know exactly what's going on in this space. Number 6, one of my favorites. Number 6, there are no required minimum distributions. There are no required minimum distributions, folks. If you are a person that's in your 70s, unlike qualified money in retirement plans or IRAs, there are no required minimum distributions from life insurance policies because it's funded with after-tax dollars. Okay? So giving retirees no choice but to basically have access to their cash value in their life insurance if they need to supplement their retirement income. I think that's important. There are so many people who have stored away IRA money for a very long period of time, not understanding that there comes a time the government's going to knock on your door and Uncle Sam's going to have his hand out. And it's going to be time for you to pay. And that's that minimum distribution. And that may be more money than what you want to pay at that time. You got to pay taxes on dollars you've never paid taxes on. But if you've accumulated this nest egg of cash in your policy, this may never become an issue because the dollars that we pull from the policy, once again, those are policy loans that allow you access to capital without taxes. Okay? If you're following me, let me know. How we doing out there today? I got one comment today. Good deal. Hey, Miss Henderson, what's happening? We got one comment out there today. So I know you guys are out there writing this stuff down. It's okay. You can always go back and play it back. You can go back and play it back. Hopefully you decide to share with your family and friends, though, because we need you to do that. We need you to share it with your family and friends. Number 7. Hey, there's an accelerated death benefit rider on some of these policies that you may want to talk to your agent or your advisor about for situations that come up when life happens. And we call this when the lights go out, are you ready? You want to be ready. We're anticipating the longer we live that things are going to happen. So we want to be ready for those things. We don't want to be waiting until it happens and then you don't have anything and you're not prepared for it. I'd much rather you be prepared for it. So most people don't think about their own demise. To think about it is kind of depressing, right? No one wants to be depressed. Everybody thinks it's something that we could think about at another time. But even more depressing is the idea of having a long illness prior to your eventual demise. You know, that's what they say. Not completely gone, but almost gone, but you have to live with it. That's probably the worst way to think about it, you know. However, being able to have access to part of your death benefit from life insurance policies while you're still living may provide your family some peace of mind and the relief of out-of-pocket medical expenses so you can pull this money in advance if you get in a difficult spot so that you could hopefully resolve the issue that's causing your quality of life to depreciate more and more. I think this is important on most policies. Sit with your advisor and make sure your policy has that, or review it. It's time for a policy review anyway. It's the middle of the year, and your advisors need to sit down with you, or you need to sit down with them, or give them a call and see if we can go through this thing one-on-one with you. And hey, look, does my policy have these features in it? All policies are not designed the same. So we want to make sure that you understand that right before, from the beginning, that, every once in a while, somebody has an agent on their first day. An uncle, a cousin, a family member, a friend. And maybe your policy was designed prematurely before that advisor knew more about the business. So it's a good deal. You don't realize how many times we see that because of the turnover in the insurance industry. It happens more than you may think. That policies may not have the mature thought in the design. and you may be holding the bag. And remember, this is your retirement. So if you're holding the bag, you don't get any do-overs when you get there. So it's important for you to stay up on what's happening. We want you to be prepared for these life happening events. Number 8, you can use life insurance as a supplement for your college funds. And I know, you got the 529 plan and you got these other things out there. And I know you haven't heard Susie, whatever her name is, or Dave, whatever his name is, talk about it on television. But I'm going to be honest with you. In addition to providing emergency cash funds, the accumulation of cash in your life insurance policy or the death benefit can also be used to help pay for unexpected or pay for expected costs or expenses such as college education. Okay? And you can use these funds without affecting your college age students' financial aid. You can use this and it doesn't affect anything. Unlike 529 plans where saving, or the college savings plan is what they call it, money inside of life insurance is not counted as a parental or student asset. It's not counted. So it makes good sense to have this additional money put away, right? So by making planned scheduled withdrawals from your life insurance plans, families can better be prepared for college if you fall short for financial aid. And we know there's a lot of people out there that have fallen short. And I know we're waiting on the government to give opportunities, but guess what? Suppose we fall short. You still may need to have these dollars available so that you can supplement that outstanding costs. Okay? So this is one of my favorites. When you need a couple of dollars, you can get your hands on it. It's pretty liquid, and you don't have to worry about a student missing out a semester or a quarter of college, and you can stay on track. Number 9, the potential for no contribution limits. The potential. I have to make sure that you understand. I said the potential, okay? Because once contribution limits to tax-deferred accounts such as the 401k, traditional IRA, or even those tax-free accounts like Roth IRAs have been reached. Once those limits have been reached, they have limits on those products. Life insurance can provide another means of saving money for retirement without the IRS contribution or income limits. And the only limits to the amount, it only limits to the amount of people that can pay for their policy, right? First of all, that's one big limit. If you can't pay for your policy, that limits you, all right? So you got to be able to pay for your policy, okay? If you can pay for your policy, you're fine. But the only other limits to the amount people can pay for life insurance is based off their modified endowment contract, or what is known as a MEC, M-E-C, which may be far from generous than other tax qualified plans out there. And what I mean by that, you have a larger threshold where you can put more money into for your savings. I like that potential based on how much money you've made, based on how aggressive you want to put your money away. If you can get yourself to a point where you're putting away 70% of your money into your own banking system, or even 100% of it, and then using it a different way. You cannot do these things with 401ks. You can't do them with IRAs and you can't do them with Roth IRAs. But potentially, you could do it if it's designed right with life insurance. And those contribution limits can be very, very large. So I personally think it's cool to have a generous portion of what I like to control. It's almost like having lasagna on an unlimited platter. You can take as much as you want, but I can control my limit of what I'm putting into it, little or as much as I want. Okay? Long as you have it designed the proper way. I hope you guys are getting what I'm putting down. Okay? It's important that you have someone sit down and go through these things with us, because if you don't, you only get one chance at it. The older you get, the more expensive it gets. You only get one chance at it. So let's make sure we do it right. Okay? So let's move on to number 10. One of my favorite reasons today is because there's no 59.5 penalty rules. You know why? Because it's not a government-sponsored program. There's no 59.5 rule, ladies and gentlemen. The assets that are left to accumulate in a whole life insurance policy, not only are they tax deferred, but they can be taken out income tax free at any time without penalty. There's no need to wait till you're 59.5. That's why I say earlier, if we want to leverage this product, the younger you are, the better we understand this product. Why do I have to wait until I'm 59.5 and I'm 25, 32, 41? When I got access to these dollars right now, and I can pull them out income tax free and leverage it in such a way that I could have a hedge against inflation. Do you know how many people are only waiting because they see the 59.5 rule, or they're intimidated by the 10% penalty, when they could have been buying products and they could have been buying services or real estate and or starting businesses long ago, had they understood that leveraging something, this opportunity in life insurance, would have allowed you to do so earlier in your lifespan. So there's no need to waiting till you're 59.5 for one of these other expectations to apply. You don't have to worry about that. And you can avoid this 10% penalty being imposed as with your tax qualified plan. So why wait? I don't want you to have to wait. So this allows opportunities for retirees to take out their withdrawals a little bit better. It allows you to allow tax qualified accounts to mature without you disrupting those things until they're necessary. And you're not having to pay income tax. You're not having to pay income tax at this time because you're taking it as loans against your whole life policy. People love it. Why? It's flexible. The dislikes of being penalized for the use of your money early, you got to really think about it. If you got $100,000 in one of those other plans that I discussed earlier, and you need to take money out, first of all, you got to remember there's a 10% penalty withdrawal right off the top. So on $100,000, that's $10,000 right off the top. Then you got to keep in mind that you haven't paid federal and you have not paid state taxes. So depending on where you are in your income tax on the marginal tax bracket, you could be paying a lot more just to access your money, especially if you're under 59 and a half. But if you have these dollars put away in our favorite financial tool called life insurance, I can go to my policy, take a loan against my policy, no 59 and a half, no 10% penalty, no state and no federal taxes are due at that time. So these are my top 10 reasons why I think life insurance should be in your retirement plan, right? I think these are the reasons why you want to leverage yourself so that you have different pots to pull your money from. So let's just recap these things real quick so you have them. Number one, freedom to spend your assets the way you want to. And if you're going to do that, we want to have the freedom to use it however we want. However we want. Number two, you want to increase your Social Security benefits for yourself and for your family. We've talked about how that can happen. We want to have tax diversification so that we can have multiple places that we can minimize our taxes in one way and not necessarily have to use or create a tax for ourselves when it's unnecessary. Asset allocation, number 4, is so that we can continue to buy other things and leverage or hedge against inflation using policy loans and then going out and buying things and being able to put ourselves in position to be ahead of inflation. I think these things are important tools because this is what's coming up right now. Number 5, the cash reserves, having an emergency fund. You absolutely need to have an emergency fund. One thing I did not say, having an emergency fund that keeps on earning even when you use it is not a bad emergency fund. Meaning that we've talked in earlier shows about the importance of dividends and how they continue to grow. So one of the advantages of having your cash value insurance is if you have a dividend participating whole life policy, those dollars are still eligible for dividends, even when you're using your cash. So that was a great one. Number 6, required minimum distributions. You don't have to wait to use your funds. You can use your funds without having to pay unnecessary taxes that most of our seniors are worried about because they've accumulated a lot of money over time. And when you've done that, you're concerned about what that tax is going to look like. So, number 7, talk to your agent and your advisors about the accelerated death benefits on policies. These are the lights out moments, being prepared for lights out moments where you have access to your capital. You can go into the policy, pull from your death benefit early if necessary, right? If necessary to help you save your situation, your family's situation, and reduce some of those medical costs. Number 8 was a supplement to saving college money. Just in case your student aid falls short, you have access to this capital. Or if you start planning now, parents, you can start overfunding your kids' plans right now so that they have dollars or you have dollars prepared for them. And you have access to it without taxes. Why? You're taking the policy loan, applying it towards the college loan or college tuition costs, and then you have the ability to pay yourself back. And guess what? You're still earning a dividend. You're still eligible to be earning dividends at the same time. So you're not going to be paying a lifelong debt for college funds. In other words, there is an end to the madness, and you can control it. Number 9, potentially no contribution limits. That just means it's based on how your policy is designed. If your policy is designed to put in much more money than what you would an IRA, a 401k, or a Roth, potentially those limits of contribution are up to you. It just depends on how it's designed and created. So if you've already got the policy and it doesn't allow you to put in a lot of money, it's time to sit down with your advisor and talk about having a new one designed and created just for these specific reasons of using money that now you have, and you want to put it away in a safe place. And last but not least, number 10, no 59.5 rule, no 10% penalties, no waiting. You don't have to wait to leverage your funds. You can do that without being fearful of paying a 10% penalty on your cash value. That's one of my favorites that I know that our clients and the folks that we've worked with over the years, one of the reasons why they don't want to touch their funds is because they're scared of how much taxes. Or I have one very specific client that doesn't like paying penalties. Well, life insurance is a great, great opportunity for her to leverage herself. And when we need to make other things happen, you can go right to this emergency fund, this secret financial tool that we call life insurance, and you can pull from it, right? So I want to thank you guys today for bearing with us and going through our top 10. If you have any comments down below, I want to make sure that you remember to do a couple things. All you have to do is put the word comment and put the word takeaways. I know I gave you some nuggets to take away for today. Out of these top 10, I'm hopeful that they're useful to you and that you can use them and they help you get to where you want to go. And I want to thank you in advance for watching Lifestyle Focus Wealth. And guess what? Tune in next time. Tune in next week, Friday, 1 o'clock. Hang out with your favorite guy right here. And we're going to talk about something else that millionaires and billionaires do. And hopefully it helps you on your way to the top. Because we got everything we need in this room. And all we need is you. So remember, don't forget to talk about us. Don't forget to share. Don't forget to hit the like, the share, the notification bell, and all those things, because we want to see you on our very next show. Hey, that's my time for today. I'm Ronco Johnson. This has been When the Lights Go Out. Are you ready? And I look forward to seeing you next Friday. Have a great weekend. Stay blessed, stay safe, and I'll see you soon. Have a good day.